Hey everyone, welcome to this explainer. Today, we're diving straight into what I like to call the Goldilocks zone of investing. You know, not too hot, not too cold. If you've been racking your brain trying to figure out how to assess long-term capital growth without strapping yourself into a financial roller coaster, well, you're exactly where you need to be. We're going to break down the structure, crunch the data, and uncover the real value hiding in large and mid-cap funds.
All right, let's kick things off with this absolutely massive number, 1.6 lakh crore rupees. That's the wealth managed by just the top 5 funds in this specific category. A lot of investors actually overlook this space, kind of assuming it's just stuck in the middle. But this number proves it is absolutely no small corner of the financial world. It's actually a major anchor for some very serious wealth.
So why does this matter? And why is so much money parked right here? Well, to get that, we need to look at the structural blueprint. By SEBI regulations, these funds are legally required to follow a very strict 35-35 rule. Basically, they have to invest a minimum of 35% of their total assets in large-cap equities, think your top 100 established heavyweights, and at least another 35% in mid-cap equities. The big takeaway here, this legally enforces balance. It completely prevents a manager from going rogue and drifting entirely into risky small companies, or, on the flip side, getting overly concentrated in just a few massive corporations.
Here is exactly how we'll unpack all this today. First, the Goldilocks investing zone. Then, performance and cap distribution. After that, decoding the risk metrics, followed by benchmarks and peer comparisons, and finally, the long-term advantage. To keep things super concrete, we're going to use the HDFC Large and Midcap Fund as our real-world, data-driven case study throughout. Part 1. The Goldilocks Investing Zone, Balancing Risk and Reward.
Let's set the baseline for why these funds even exist in the first place and the specific problem they solve for you. For beginner or moderately conservative investors, pure large-cap funds can honestly feel a bit sluggish, while pure mid-cap funds, those can be terrifyingly volatile. So this category acts as a built-in structural solution. It's that perfect middle ground, deliberately engineered to give you the fortress-like stability of established companies right alongside the dynamic, much faster growth potential of emerging businesses.
Moving on to Part 2, Performance and Cape Distribution. Let's look under the hood. Looking at our HDFC case study right here, you can literally see that mandatory 35-35 rule in action. They've got over 45% allocated to large caps and nearly 38% in mid caps. But remember, that leaves a 30% discretionary window for the fund manager to play with. In this case, management has actively used that window to put about 16.78% into small caps. That is a highly deliberate, active valuation overlay meant to generate extra alpha, or excess return, all while relying on that massive large cap base to keep the whole portfolio firmly anchored. And let me tell you, that asset distribution really drives results. Just look at the historical performance. We're seeing an 18.37% compound annual growth rate over 3 years and a 17.46% CAGR over 5 years. That is a serious pattern of strong long-term compounding. But as any seasoned investor knows, just looking at raw returns in a vacuum, yeah, that's a rookie mistake.
Which brings us to Section 3, Decoding the Risk Metrics. Time for the stress test.
Because frankly, raw returns are only half the story. We absolutely have to evaluate market volatility. Now, don't let these numbers intimidate you. If you're a conservative investor trying to assess long-term growth, comparing these metrics against the category average is exactly how you measure true downside protection. It's how you look past the flashy marketing and see the actual math. Let's break down the big ones. First up, we have standard deviation, which is really just a fancy way of measuring the range of an investment's performance. It's volatility. The category average sits at 17%, but the HDFC fund, it's sitting lower at 16.58%. The crucial takeaway when you translate this math is simple. A lower standard deviation directly translates to fewer bumps along your investment journey. You're getting tighter return distributions and a much smoother ride. Next is Jensen's Alpha. Think of alpha as the manager's hidden value add. It measures the excess return generated over what was mathematically expected. The category average is 1.36%, but check this out. This fund achieves a 2.56% alpha. This completely answers the beginner's ultimate question of how to assess active management. It literally proves the fund manager is out there actively finding and adding excess value, rather than just passively riding the market wave. Finally, we have beta, which measures an investment's sensitivity to broad market movements. Now, the baseline market is always 1.0. Here, the fund has a beta of 1.08, which is slightly higher than the category's 1.06. But wait, while that beta is marginally higher, meaning slightly more market sensitivity, remember that lower standard deviation we just talked about? The active valuation overlay by the management prioritizes cash-generating assets to keep the overall portfolio volatility perfectly in check.
All right, part 4, benchmarks and peer comparisons. Let's step into the arena.
Let's really prove the value of this structural approach. When we pit the fund directly against the broader Nifty 500 benchmark, the advantage is honestly pretty obvious. Over a trailing 3-year period, the broader market benchmark delivered 13.53%, but the actively managed fund? It delivered 18.37%. That is a significant, consistent outperformance, and it really proves the value of expertly picking stocks within that strict 35-35 parameter. But what happens when we go head-to-head against a major peer, like the Motilal Oswal Large and Midcap Fund? This is where it gets fascinating. While Motilal boasts a noticeably higher 3-year raw return at 24.49%, you've got to look closely at the expense ratio. That's the cost you pay the fund house. It sits at a fairly hefty 2.41%, compared to HDFC's highly efficient 0.79%. As an investor, you have to carefully weigh these differences in cost efficiency against raw historical returns when picking your specific vehicle. And finally, Section 5, the long-term advantage. Let's focus on the horizon. To really synthesize all these metrics we've been talking about, we have to look at how holding periods fundamentally alter your risk profile. Historical modeling brilliantly illustrates that if held for more than 10 years, this specific category of balanced equity has historically delivered more than a 10% CAGR in a staggering 97% of instances. It's incredible. The longer you hold, the more the probability of a positive outcome converges on absolute certainty. In fact, the data proves that for anyone assessing long-term capital growth, time is literally your ultimate risk management tool. In year 1, your standard deviation, meaning your risk, might be as high as 27%. But if you stretch your horizon out to 20 years, that statistical volatility drops to just 2%. Your risk aggressively reduces as your holding period increases. It is entirely about time in the market, not timing the market. Conversely, attempting to time the market instead of just staying put, that will severely punish your long-term compounding. If you get spooked, pull your money out, and miss just the 10 best days in the market over a multi-decade period, your final portfolio value is effectively cut in half compared to someone who just stayed fully invested. No way around it. That's a massive loss.
Ultimately, these key advantages make the large and mid-cap category an incredibly sensible, diversified anchor for your portfolio. You're getting a balanced risk-return profile, built-in structural diversification, and crucial behavioral support simply because you experience way fewer deep drawdowns than you would with pure mid-cap funds. Add in the high tax efficiency of long-term holding, and it provides this beautiful simplicity for anyone willing to commit to a 5 to 10-year horizon.
Which brings us to our final question for today. Take a really hard look at your own assets. Does your current portfolio actually have the right middle ground exposure to confidently balance stability with growth? Or are you drifting a bit too far into the extremes, unnecessarily risking your hard-earned wealth? It might be time to review your blueprint. Thanks so much for joining us for this explainer, and we will catch you next time.